Thanks, disclosures. As I said before, my name is Natalie Beckett, and I will be your moderator today for another free educational webinar with Avant-Garde Trading. This afternoon, we have special guest Chuck Hughes. He is the 8-time winner of the International Options Trading Championship, and we're happy to have him here. Chuck, are you there?
Yes, can you hear me?
Yes, I can. Yes, I can.
Okay.
Thanks for being here. So without further ado, I will go ahead and give you the reins, and Chuck, you can take it away. Coming over to you now.
Okay, good.
If anyone has questions during his webinar, feel free to put them in the chat box. I will try to field them to Chuck, or if not, we can see if there's any time at the end of the presentation for Chuck to answer. All right, you look good, Chuck. I can see your presentation.
Okay, good. I'm going to switch over to slideshow presentation. Okay, good. Well, thank you, Natalie. It's great to be here today. I have a program on trading options with high accuracy. We've been using this program for many, many years, and I'm going to show you some trades that we have on right now. So we're doing well in the current market environment, despite the volatility and the non-trending markets. The S&P and NASDAQ haven't done much over the past year, but we've been able to identify trade opportunities that have done very well despite the non-trending markets and the constant volatility. So option trade selection will show you how we select option trades, and then once we put the trade on, we have an option trade management program, which we'll go into in detail, and that's actually a big part of our success, is how we manage our trades. Then we're going to identify what we call super stocks that have outperformed the major averages with a lot less volatility. And these super stocks are performing very well in the current market environment. Just to give you an idea, these are charts of, I have the NASDAQ daily price movement over the past year at the top here, and you can see there's a lot of volatility with very little trend. So if you're trying to trade during this volatility, you could easily get stopped out of your option position. So we would much rather trade a company like NiSource, which is a gas utility, which with a lot less volatility, and this super stock outperforms most growth stocks and market sectors with very low volatility. So we like to focus on these super stocks as a way to profit in the current market environment. Here's another example. I have daily price movement of Netflix at the top here, and at the bottom I have daily price movement of American Waterworks, which is a water utility. So again, there's no need to trade stocks like Netflix when you can trade these super stocks that are much more consistent with low volatility and yet provide good return. So we look to buy call options on these super stocks, and that's been doing very well. Trade selection first, and the first step in our trade selection is to identify the price trend of a stock. And if the price trend is up, we're going to buy call options. If the price trend is down, we're going to buy put options. And then once we price trend, whether the stock is on a buy or a sell signal, then we want to select a low risk entry point for our option trade, and I'll show you how we do that. We use what we call the major trend system to identify the price trend of a stock, and that allows us to trade with the trend instead of trying to predict the future price movement of a stock. And the 1-month price in relation to its 20-month exponential moving average is a good way to identify the major trend of a stock, and we've been using this trend following system for many years. So with the 1 day, the nice thing about this is we only look at the price of the stock in relation to its 20-month EMA on the last trading day of the month. And then we ignore all other trading days. And it's a month to check the price trend of stocks and see potential trades, and just determine whether the stock's in an uptrend or in a downtrend. Very simple system. So the major trend system is on a buy signal if the 1-month price is above the 20-month EMA on the last trading day of the month, and sell signal if the 1-month price is below the 20-month EMA on the last trading day of the month. And I just wanted to mention that today we're going to cover bullish trades because there's a lot of opportunities on the buy side with these super stocks. And just keep in mind, though, that during the last two severe bear markets in 2008 and 2001, we were heavily short the markets using the major trend system. So we got sell signals on most stocks and sectors back then, and we were heavily short. So we did well during the last bear markets. But today there's more opportunities on the buy side. So the price movement of a stock reflects all the known information about a company. So we simply use the major trend system to follow that price trend. So all the news about a company will be reflected in its price movement, so we just simply follow that price movement. And the 1-month and 20-month EMA price charts, they're easy to download from stockcharts.com. Buy signal for NiSource, and this buy signal actually occurred back in 2009, and it's still on a buy signal. But this blue line right here is the 20-month exponential moving average, and the black line here is the 1-month price of the stock. And we can see that in May and June of 2009, the 1-month price of NiSource was below this 20-month moving average. So right in here, in August, the 1-month price on August 31st was, or the last trading day of August was, you can see it crossed above the 20-month EMA. So at that point, the stock was on a buy signal, and as long as the 1-month price stays above this 20-month EMA, then the stock is on a buy signal. See, back in here in August of 2009, NiSource went on a buy signal with the major trend system at around the $4 level, and it's trading up at around $22.74. So that's a great return. And you can see this 1-month price here is the red and black line. As long as that remains above the 20-month EMA, then that stock is on a buy signal. So we've been trading this stock for many years, and it's produced very good returns with very little volatility or stress. Want to buy the stock or a call option on the stock if it's on a buy signal with the major trend system, which is the 1-month price above the 20-month EMA. And let's look at an example of a sell signal. This is for American Express, and we have the 1-month price, which is this red line right here, crossed below the 20-month EMA, and it looks like it was around of last year. So again, the 1-month price crossed below the 20-month EMA. So at that point, American Express was on a sell signal, and that was around the $80 level. So with it trading at 53, you can see that if you had followed this system and sold your long positions when it was on a sell signal, it would have saved you a lot of. We like to just simply follow the trend. All the information about American Express is reflected in this price movement, so we just simply follow the price movement, and we buy stocks or call options when they're on a buy signal, and we sell stocks and buy put options if the stock is on a sell signal. So pretty simple system. We like trend following because we use a system instead of emotional decision making, and we've been using trend following successfully for more than 30 years. So we use the major trend system to identify what we call super stocks, and these super stocks typically have consistent and predictable price patterns, and they've had a steady price increase over the past 20 years. And the super stocks usually they outperform the major stock market indexes, and they have a low number of sell signals, which is another advantage to this longer term system, is you're not in and out all the time getting whipsawed. So number of sell signals, and we simply buy the strongest stocks and just hold them until the trend changes. So that's a longer term system, but you get less whipsaws, less sell signals. You're not in and out as much. So here's a few examples of super stocks. This is Starbucks, which has had a 10-year total return of 283% versus the S&P over that same period at about 94%. So times the performance of the S&P with lower volatility. You can see the buy signal came in around the middle of 2009, and it's been on a buy signal ever since. Stores, retail stores, that's another great stock we've owned for a long time. 10-year total return of 258% versus 94% for the S&P over the same time. And you can see, very here, and we just follow this price trend up and profit with our option trading system. Here's Reynolds American, 10-year total return, 239% versus 94%. So these are the kind of stocks that we like to trade. We found that with less volatility, we get stopped out of our position fewer times, and yet at the same time we get a good return whether we buy a stock or we buy the call option. We get a good return with these low volatility stocks with a lot less risk. This is Extra Storage. This is a real estate investment trust. 10-year return, 284% versus 94%. Here's foods. And a lot of these names are not very well known, but you can see that these relatively unknown stocks really do very returns with low volatility and lower risk. So these are examples of super stocks that are paying dividends, and they have very reliable, predictable price patterns. And these super stocks have outperformed most growth stocks with a lot less volatility and risk. So there's no need to trade high volatility stocks that incur a lot of risk. And here's a couple of examples of high volatility stocks that have no clear trend, and we just simply avoid these kind of stocks. Just First Solar. This is Sotheby's Holdings, and you can see if you try to trade these stocks with this kind of volatility and very little trend, you're going to get stopped out of your position, whether you take a long or short position. Here's the China ETF. Again, a lot of volatility, not much trend. There's a Sony Corp below here, so we just simply avoid these kind of stocks, Corning and Caterpillar. So there's no need to trade these kind of stocks when we can trade super stocks. Now about the super stock option strategy, and call options on stocks that are in a major trend buy signal, and then we use the Keltner channels to help select a low risk entry point. And then once we select a trade, we want to use the what we call the 1% rule to select the option strike price. So this is how we select option trades. We want to trade stocks that are on a buy signal according to the major trend, and then we use a lot of these stocks have already made big moves, so we use the Keltner channels to select a low risk entry point, and then we use the 1% rule to select our strike price. In the super stock option strategy, we use the major trend system to identify super stocks that have consistent and predictable price patterns and steady price increases over the past 20 years. And they typically have low volatility, they outperform the major indexes, and they have a low number of sell signals. So we want to trade call options on stocks that are on a buy signal, and derivatives that derive their value from the price movement of the underlying stock. So we use the major trend system to identify stocks in a price uptrend that are moving up in price, and this allows us to use the tremendous leverage that options provide. So stock moving up in price, of course, and you buy a call option, then you're going to use that leverage to your benefit, and you can really perform. You can really do well with these super stocks by buying call options on them as they're moving up in price. So we use the Keltner channels to select our entry point, and a lot of times these super stocks, they're already up substantially. So the question is, where do you jump in if you want to buy a call option and participate in that price uptrend? So we use the Keltner channels to identify a good buy point, a low-risk buy point when we're trading these super stocks. So here's a daily price chart of Home Depot stock, and we to time our entry. And there's three channels. This upper blue line right here is the upper channel. The dotted line in the middle is the middle Keltner channel, and the lower line is the lower Keltner channel. And overbought, oversold indicators, they're similar to the Bollinger Bands, but I've had more success with the Keltner channel, so I prefer those. And that you want to buy the stock or buy a call option on the stock when the stock is trading near this middle channel or the lower channel. You don't want to buy when the stock is trading up near the upper channel, because that means the stock is getting overbought and it's vulnerable for a pullback. So we simply wait till it retraces to that middle or lower channel, and then we make our entry. So indicator, a great tool to use when you're trying to time your entry. And we don't want to buy when the trading near this upper channel. Again, we want to wait till it retraces. So you can see Home Depot here retraces, rallies, retraces, rallies, overbought, retraces, oversold, rallies, overbought, retraces, oversold, rallies. So you can see it follows that pattern. So if you simply buy when the stock is trading near the middle or lower channel, then you can really reduce your entry risk. And I'll show you some examples of that. Here's some super stock option trade examples. And this is the utilities ETF. This is the 1-month price of the utilities ETF and the 20-month EMA. And you think the utilities, that they're pretty low growth, and it seems like the growth stocks would perform much better than utility sector over time, but they really don't. And if you compare these, that utility sector, it outperforms the S&P. So here's an example of the utilities ETF. We waited till there was a retracement to the middle channel before we bought a call option. So this is the daily price movement of the utilities ETF, and we have the channel here, the middle channel, which is the dotted line, and the lower channel. So it's on a strong price trend for many years. And the question is, where do you want to jump in if you want to buy a call option? So we waited until it retraced to the middle channel here, and I got the 40 strike call right in here. And then you can see once we bought this call, then the price really didn't retrace from this price level here. Now there were sell-offs along the way, but allowed us to get a low risk entry right here, and the sell-offs were contained above our entry price, so we didn't get stopped out of this one. We just simply held that, and have done pretty well with this option. Here's another one, the consumer staples ETF. This is comprised of stocks like Procter & Gamble, Johnson & Johnson, Coke, very stable stocks, and you can see the price trend's pretty consistent with this consumer staples ETF. So this is full of super stocks, and this is a great way to participate in these blue chip stocks by just buying this ETF. So you can see a very long, consistent pattern of growth here. And the question is, where do you want to jump in if you want to buy either the stock or the call? We waited again till March 2nd, right in here, and you can see it retraced towards the middle Keltner channel, and we bought the 45 strike call right in here. And again, this didn't really retrace from our entry point. It did have sell-offs with the general market, but it stayed above our entry point. Here's another one. This is Realty Income. This is a real estate investment trust that invests in retail properties, and this is another example where we waited till a retracement, and then we bought the 45 strike call on Realty Income, symbol O. So here's Starbucks, and with this right in here when it retraced towards the middle channel and got another low risk entry. So the Keltner channels allowed us to get low risk entries in these stocks, and even though the market was volatile after we entered these trades, we didn't get stopped out because it didn't really retrace to our buy point. So we were able to hold these positions, and these are all doing well now. If we select an option trade, let's talk about the 1% rule for selecting an option strike price. And an option trade, there could be hundreds or even thousands of strike prices to choose from. So selecting the strike price is pretty important. And options consist of time value and intrinsic value. and options lose all time value at expiration. So when you buy a call option, you're buying a decaying asset. So you always want to keep that in mind because the time value is going to decay to zero, and each day as you approach expiration, the value will lose, the option premium will lose a little bit of time value until it goes to zero at expiration. So due to these time decay characteristics, when we buy an option, we want to minimize the time value and maximize the intrinsic value. So we came up with a simple rule of thumb, and to less than 1% of the stock price to minimize the time value and maximize the intrinsic value. And if you purchase an option on a stock that's trading at 100, then you want to limit the time value portion of the option to 1 point or less, which would be 1% of the stock price. So we want to limit time value portion of an option to 1% or less of the stock price. So when you do that, the underlying stock only has to go up 1%, and then that option is profitable and you start making money on it. So that's the whole goal with the 1% rule. The go up 1% and you're going to start making money. So let's look at an example of an option trade we made and using the 1% rule. This was for Starbucks, and Starbucks 40 strike call at $13.75, and at the time Starbucks was trading at $53.63. So this was an in-the-money call option because the strike price was lower than the current stock price. So we bought the 40 strike call. The stock is trading at $53.63, so this is an in-the-money call. And with the $363, if you subtract the stock price, you get the intrinsic value. So the intrinsic value of this option was $13.63, and we paid the total $13.75. So if we subtract that intrinsic value of $13.63 from the total option premium of $13.75, we get the time value. In this example, it was only 12 cents. So $13.63 in intrinsic value and only 12 cents in time value. And we developed a series of option calculators over the years. We have 6 different calculators for 6 different strategies. And we use these calculators before we take a trade, and they will potential for an option trade or a spread trade, assuming various price changes in the underlying stock at option expiration. And in this example, we have this is the call option purchase calculator, and we look at on the price movement, in this case of Starbucks stock at option expiration. And in this example, we're looking from a 30% increase in the stock price to a 5% decrease. So what is this profit potential for this option we purchased, and it also value and intrinsic value, and in this case 12 cents time value, $13.63 in intrinsic value, and then it'll give you the profit potential based on this price movement. So if Starbucks stock is up 10% at option expiration, then the option will have a 38% return. If Starbucks is up 20%, the option will have a 77% return. So, and if the option is flat, in this case at 53.63, then we'll only have 0.9% loss on our option. So that's a lot better than 100% loss if you buy an at-the-money or out-of-the-money call and the stock doesn't price, then you lose 100% of your premium. So in this case, even though we're getting a decent return for a 10% price move or a 20% price move, you can also see our downside is a lot less. And if the stock is flat, we only lose 1%. If it's down 5%, we lose 20%. So the 1% rule allowed us to buy an option with high intrinsic value, low time value, and 12 cents of time value. Again, Starbucks stock only has to increase 12 cents or 0.2% for this trade to break even and start making money. So, and then any increase above 12 cents will result in a profit, and we would rather between the leverage that out of the money options provide and reduce our risk. So it's a trade-off. The out of the money options, of course, will have a higher percent return if you're right, but if you're wrong, then you also can lose 100% very easily, very quickly. So a lot of times a stock will not make the expected move prior to option expiration. So we'd rather money call and have a lower break-even point. You know, if the stock only has to go up 1%, we start making money, we're going to have a much higher probability of success than buying an out-of-the-money call that requires, let's say, a 10 to 15% price to break even, because a lot of times you're not going to get that price increase, and then you're going to have 100% loss. So we prefer to use this 1% rule when we're to select the strike price. Okay, so after we select the strike price and we enter the trade, then we have several trade management rules, and these are just as important as the trade selection. And we have what we call the 20% rule for walking away from the trade. And we also like to roll over our option at option expiration if the stock is still on a buy signal and the trade is profitable. And then we also have what we call the 30% rule for protecting profits. So the first trade management rule, the 20% rule for walking away, and this is simply a stop loss rule that we have with our options. And the goal of this rule is to prevent a small loss from developing into a big loss, which can really hurt your portfolio. So if an option's price drops 20% below the entry price, then we start looking to exit that option trade, and we definitely exit before it hits 30%. So most of the time, if we have a 20% loss in the option, then we simply close the option out and we look for a better opportunity. And what we're trying to do is help prevent 100% loss of our option premium, because if you have several of those, you could be wiped out. So the 20% rule, this is for Johnson & Johnson. And in this example, we bought the 80 strike call at $23.72. So the premium we paid was $23.72. If the premium drops to about 19, that would be a 20% loss. So if it drops to 19, that's a 20% loss on the premium that we paid. So at that point, we would look to exit that trade, and we would definitely be out of the trade before it drops to 30% in this example, which would be about $16.50. So with this stop loss rule, we don't have to watch the markets closely. We simply look at our positions every day, and if we start to get towards this 20% loss, then we'll simply exit the trade. And stop loss that doesn't fit closely, you just simply look at it every day and see how your position's doing, and then if you get close to a 20% loss on your trade, then you start looking to get out. limiting losses, the goal is to limit losses that can ruin your portfolio. So if you incur a 20% loss on a trade, it takes a 25% return on the next trade to break even. A 30% loss, it takes a 43% return on the next trade to break even. And of course, if you take a 50% loss, it takes a 100% return on the next trade to break even. And how many 100% wins have you had lately? So you don't want to be in a position where you're getting into these larger losses, because they're really hard to make up. And if you have a 75% loss, then it takes a 300% return on the next trade to break even. So we want to avoid these big losses, which are really hard to make up, and limit our losses to 20-30%. So if we can survive and move on to the next profit opportunity and stay in the game. Is we roll over our options at expiration if the stock is still on a buy signal and the trade is profitable. If it is, then we normally will roll the trade over. And when you roll over a profitable trade, of course, you're carrying your profits into your next trade. So that trade and the risk of your next trade, and it allows you to compound your returns. So we normally just keep rolling over, and a lot of times we can reduce our risk to zero after several rollovers when we're rolling over the profit from the expiring option and reducing the cost of the new options. If we just keep doing that, a lot of times we reduce our risk to zero. Examples of rollovers we did recently, and this is my gains and losses report. And what this shows is we closed out the realty income, symbol O. We closed out the April, and we had a $321 profit on the April 45 call. This is the QQQ NASDAQ index. We closed out the April 95 call, and we had a $509 profit. This is VNQ. That's the Real Estate Investment Trust ETF. This is the XLP Consumer Staples ETF, and the XLU, the Utility ETF. So this lists our gains right here in this column. So what we did was we rolled these trades over because these stocks and ETFs were still on a buy signal, and we had a profit on it. So, for example, we closed out the Utility 40 strike call. We had a $216 profit on that. So we rolled into the September 42 strike call. So we closed out the 40 strike calls that was expiring and bought the September 42 call. So the cost of the new option was $690. We had a $216 profit. So the new cost for the option is $474. So we reduced our risk by 31%. So the profits from the closeout of the 40 call were rolled into the 42 call. And we used a option spread order to close out the expiring option and to buy to open the new option. And we use limit spread orders, and we can save on the bid-ask cost and also on commission. So we like to use rollover trade. We like to use spread to roll over our trade. So in this case, this is a spread order to close out the April 40 call and to buy to open the September 42 strike call. So if you put a limit order in, halfway between the bid and ask price, a lot of times you can save on that transaction cost of the bid-ask spread. This is an example of VNQ, which is the Real Estate Investment Trust. We sold to close the April 65 call, and we had a $319 profit on this 65 call. We bought the September 70 call, and the new call cost us $1,015, and we reduced our risk by 24% in this case. And here's one, the QQQ, and we were able to, on this trade, we had a $509 profit. We closed out the April 65 call, and we bought the September 70 call, and the $509 profit reduced the cost basis. The new cost basis was $779. So we reduced our risk by 40% in this example. So we roll over these profits, and that allows us to reduce risk and compound our returns. And a lot of times, like I mentioned, we can reduce that risk to zero. Trade selection or trade management, about trading option spreads. And our third trade management role is to use what we call the 30% rule for protecting profits. And what we do simply is if we have a 30% or more profit in our option, then we create a spread trade, and that helps protect our profits. So whenever we get a profit, we want to protect it, especially with the market conditions the way they've been. When you get a 30% profit, 30% or higher profit, then you definitely want to protect your profits from market down moves, and this has worked out very well in the current market environment because these spreads provide downside protection. And so the rule is if we have a 30% or greater profit in a call option, then we sell a call option with a higher strike price, and that creates an option debit spread. So if we buy an option, of course we use the protective stop rule to get out of the option, and if we don't get stopped out and we have a profit, then we want to sell a call option with a higher strike price, and that creates a spread and to help protect the profit. So when you purchase an option and you have a profit in that option, if you sell a call option at a later date, you increase the profit potential of the existing option purchase, and at the same time you're providing downside protection in the event the underlying stock decreases in price. So when you have a bullish debit spread on, the call option, of course, will profit if the price of the stock increases, and the short call option will profit if the price of the stock decreases. And you can profit when you have these spreads on. You can profit whether the stock closes up or down at option expiration. So we always like to protect our profits, especially in this market environment, and create these spreads. And your risk is limited to the cost of the spread with these debit spreads, so you don't have to worry about unlimited risk. So let's look at a few examples. This is an option debit spread we created for Realty Income, symbol O. We bought the 50 strike call. This says 500, that should be 50. We bought the 50 strike call at 879, and we had a profit in that trade. So we sold to open at a later date the Realty Income 60 strike call at 450, and that created an option debit spread. So we had a profit in the 50 strike call, and at a later date we sold the 60 strike call at 450, and these were both September. So we bought the September 50 call, and we sold the September 60 call at 450. So let's take a look at the risk profile of this debit spread now that we have a spread on in this trade. So selling the 60 strike call for 450 resulted in an increase of the profit potential of the 50 strike purchase that we already had on. So the 50 strike purchase, at the time we initiated this spread, it had about a 417 profit in the call option. So when we sold the 60 strike for 450, we actually increased the profit potential of this 50 strike call by more than 100%. So when you sell the call option at 450, of course, $450 in cash goes into your brokerage account. So in this example, we doubled the profit potential. We had about a 4.17 profit already in the call purchase, but by selling this, we doubled that profit potential. So, and then the 60 strike call, that also provided downside protection in the event that realty income declined in price. And of course, this short call option, that profits as the underlying stock goes down in price. So we had a long position and a short position, and this is a great way to trade in this type of market. So we have an option calculator for call option debit spreads, and again, these calculate the profit potential for the spread based on various assumptions in the price of realty income stock at option expiration. From, in this example, from a 7.5% increase in the price of the stock to a 7.5% decrease. So this will calculate the profit potential for the spread trade based on these different various changes in the underlying stock at option expiration. And we can see if realty income is flat at 64.98, then we'll have 133% return for the spread, and the profit on the spread will be $571. So that's a pretty good return if the stock is flat at option expiration. If it's down slightly, if the stock is down 2.5% or 5% or even 7.5%, we're still going to realize 133% return for the spread and a $571 profit. So in this case, whether realty income is flat or closes up or even closes down 7.5%, we're going to realize 133% return on this spread trade. So again, we bought the 50 strike call at 879 and sold the 60 strike call at 450. So return whether the stock goes up or even down 7.5%. So for the utilities ETF, bought the 42 strike call. Our cost basis is 474 and 1% profit. And we created a debit spread, and we sold the 48 strike call at 190. So we owned the 42 strike call. We had a profit. We wanted to protect that profit, so we sold a higher strike price. We sold the 48 strike call at 190. So that option, of course, increased the profit potential of the existing call and also provided downside protection. In this example, if the utility ETF is flat, in expiration, we have a 111% return. So that's a pretty good return for utility stocks. And even if it's down slightly, we're still going to have a profit on our option. This is the current market environment where you have both a long position and a short position. Here's one more example. This is for the triple Qs. We did strike call 779 cost basis, so we went ahead and sold the 109 strike call at 450, and we collected 409 call at 440, and we collected $431 in cash went into our account. So once we did that, we increased the profit potential of the 100 strike call purchase. So file on this spread, and if QQQ is flat at option expiration, we'll have a 165% return. If it's up at all, we'll have a 165% return on this spread trade and a $561 profit. We initiate these spread trades for all of our profitable call option purchases, and that's been working out very well over the last several years. So just to recap, the advantages of these spreads is the sale of the call option can increase the profit potential of the existing option purchase by 50 to 100% or more. In the realty income spread trade example, the sale of the 60 strike call increased the profit potential of the 50 strike call purchase by 108%. So by selling that call, we increased our existing profit potential by 100%. So they also provide downside protection. When you sell a call option, then cash is credited to your brokerage account, and that reduces the cost basis of the option purchase. So, and the short call will also provide downside protection if the stock declines in price. Here's a couple of examples of how these spreads reduce risk. Our original risk on the realty income call purchase was $879. So once we sold the call option, it reduced the risk to $429 because we got that cash that came into our account. So our original risk was $879, and that was reduced to $429 by selling a call option with a higher strike price. And the risk on the triple Q spread reduced the risk of the call purchase from $779 to $339. So by initiating these spreads, we also reduced the cost of our call purchase and reduced the risk of our call purchase. And we saw examples where these spreads can be profitable if the stock increases, decreases, or remains flat at option expiration. So this is a good way to trade. So that concludes